Okay, good evening guys. Before we start, as always, let's do our custom instant poll. I'll put this on your screens now. Let me know if the sound is perfect, too loud or too low. Just indicate by pressing 1, 2 or 3 on the usual way. Okay, majority of people saying perfect. Excellent guys, thank you very much. Okay, so tonight we're going to talk about trading Bollinger Bands. And I've done this on the FX markets, but really Bollinger Bands work on any markets. Very powerful tool. It's something I use pretty much on all time frames in all my charts. If you watch me in my FX Street trading clinic today, we use Bollinger Bands and they work very well. You know, I've had a couple of trades over the last 2 days, both in the FTSE, funnily enough. And if you follow me on Twitter, I'm up 8% of my account just on 2 trades. And that's using basic principles like Bollinger Bands, incorporated with things like Fibonacci. So all the things I talk about in all the education, it's all about using them in the right way, using the right kind of time frames. And these things, when you use them in the right way, you get in the extremes of the market, you get in that edge, and that's what we need. We need that 60, 70, 80% edge in trades to give us, the right entry point and also allow us to be able to run trades. So Bollinger Bands I'm a massive fan of. John Bollinger, who created them, is probably one of the best and well-known technical analysts in the world. So a lot to learn. So again, we'll go through everything as always. Any questions, just ask me. So before I start, as always, the risk warning that spread betting, CFD trading both carry high risk to your capital with the possibility of losing more than your initial investment. These products might be suitable for all investors and only intended for people of the age of 18. Please ensure you follow the risks involved and if necessary seek independent financial advice. Again, education only. Content of the webinar is personal opinion of the moderator, notrader.com. Content does not constitute financial investment or tax advice. We recommend that you discuss your specific requirements to an independent financial advisor prior to entering any bet. Intraday.com does not accept any liability for the content and comments made during this session. So, the basics. So the basic trading principles state that the price of an instrument, doesn't matter what it is, stock, commodity, security, anything that we have tradable data on, will only move away from the current level, okay, that it's trading if new market news or information changes the perceived value. So the questions we have to ask when assessing the markets is the price going up or down for valid reasons? Is the price moving into a new range? Has something material happened to change this? What is the perceived value? Okay, is the price just ebbing and flowing normal market orders? So the whole point really is understanding the markets that you traded. Some markets, on all markets, I guess, will always exhibit some sort of trend, be it upwards, a bullish trend, be it downwards, a bearish trend, or neutral, where a market just really moves between support and resistance in a sideways. And that's, again, we can cover that kind of market movement by the channel trading webinar that I've done a number of times. So markets will really move with any kind of range, but will have some sort of bias towards it, or it will just be moving between support and resistance. So once you understand the market conditions and how it's trading, you can look at to use other tools, and Bollinger Bands is probably one of the best tools to do this, to find the extremes of the market. Okay, other things you can use potentially are things like RSI, again, your normal trend lines, maybe MACD, maybe some sort of kind of stochastics. But really, for me, all these other things should be added. When you put your basic chart on, the first thing you do is you draw in higher time frame levels of support and resistance. So if you look in the hourly chart, draw in daily points of resistance, monthly, weekly points of resistance to build up, your higher time frame where the levels come into play where the market can move to from right now because you're looking at the smaller time frames. And then you stick the Bollinger Bands on because the Bollinger Bands work on any period. And, they work on any time frame. And again, they just adjust to the amount of data that you're looking at and to the parameters you set. So what are Bollinger Bands? Well, they're a technical analysis technique which use lines that are plotted to 2 standard deviations above and below the moving average. Okay, that's pretty much simple as it is. It's very much like a moving average, but instead of just having a moving average which is a midpoint, you have lines at 2 standard deviations. Now you can set these further. You can set them to 3, 4, 5 standard deviations if you want the Bollinger boundaries to be further apart, but I just stick to them in a very basic manner. I do 2 standard deviations and 20 periods. Okay, so it'll go back 20 periods in the chart, plot 2 standard deviations around the moving average, and to be honest, you can't go far wrong with that. There will be extremes when the market breaks out of Bollinger Bands and they're very wide apart, and there'll be times when they're very small and close together, but it doesn't matter. It really, trust me, it doesn't matter. As long as the Bollinger Bands are there, You can understand when the market can break and when it's overextended too far. And then other things like I mentioned, things like Fibonacci, your moving average, these are things that you can use in order to trade back to or use for your entry points. So standard deviation obviously measures volatility. So these bands will widen when the markets are volatile. They'll narrow when there's less volatile markets, when there's less trading price action. So it doesn't matter, like I said, the markets can be wild, they can be very, very quiet. The Bollinger Bands will still have a part to play. So some technical analysis consider markets whose price action approaches the upper band to be oversold. And again, when the lower band is hit, oversold. So very much the same principles as RSI. We have an RSI of 0 to 100. Over 70 is overbought. Below 30 is oversold. Again, you can tinker with those particular settings in RSI, and you can tinker with the settings in Bollinger Bands. You can set them, like I said, to further apart. But the whole point of why we use technical analysis is that other people look at it. So a lower Bollinger Band becomes oversold and relative support, I guess, because other people are looking at that. So you need to use your Bollinger Bands, your RSI, to the standard settings the majority of people in the market look at, and then it becomes self-fulfilling. So very important that we don't try and get too clever, okay? There's nobody here that's cleverer than John Bollinger, okay? Simple as that. I'm not, okay? And I've done loads of technical analysis, 10, 12 years in the markets, and I make money from John Bollinger, so I like him. If you ever met him, I buy him a pint down the pub. But his ideas, his way he interprets the market and data don't need to be tampered with. Okay, so the best thing and the best advice I'll give you about technical analysis is stick to the standard settings, okay, on the majority of your charts. Then you'll be looking at the same things that other traders are looking at. Okay, the common misconception people make when they're trading, especially when they're mathematical or quants or overly intelligent, think they're going to find a new way of trading. You're not, okay? I'll just tell you straight up, because I always do, you will not find a new way to trading. You might find a new way to interpret data, charts, put charts together, but there's not a new way of trading. Buy low, sell high. Yeah? Simple as sell high, buy low. The way you do it is interacting with the markets in a way that you can control and understand. And using Bollinger Bands, other oscillators, is just a way of refining entry points. Yeah, these things together will not make you a better trader. You still have to use them in the right market conditions and in the right way. So Bollinger Bands visually, for me, capture the market. And the thing I like about products like MetaTrader is A, they're free, and B, they make the graphs look very, very pretty, okay? Not a kind of word you're going to say, is it, in trading, but it makes the data look uniformed and controllable. And once you feel comfortable with your charts, you can make better informed decisions. So I can have 8 windows open on a MetaTrader chart, and I can look at all the data on them and feel pretty comfortable. Bollinger Bands take up pretty much no space because the 3 lines. So things like RSI, MACD, they take up screen time. They take up screen, kind of space, because you have to have new windows to show them. I have made some tweaks, and obviously my RSI, stochastics, etc. in MetaTrader are just arrows. So up for buy, down for sell, sideways for neutral. That's just a space-saving technique. It doesn't tell you anything else than anyone else in the market knows. But again, if you can make any of these adjustments to your screens and make them less complicated, then you're going to benefit from them. The biggest mistake you see is people on Facebook, and I love it when people post, this is my trading screen. They've got 2 laptops, 4 monitors, they've got TVs on in the background. Are you going to be able to assimilate the information from 4, 5 screens, and each screen's got 8 screens on? You're not. You're not plugged into the matrix here. You're just a normal human being. And the more things you have on the chart, the more things you have to confuse yourself and give you conflicting signals. So for me, stick a Bollinger Band on every chart doesn't make any difference. It doesn't really affect your charts in any way, and it brings a lot to the table. So again, for me, they visually capture the market movement, and it works on any time frame. So I'd recommend that definitely, we do try them out. So again, other points to consider when you're talking about Bollinger Bands, they deviate 2% around the moving average. So moving average is a lagging indicator, simple as, okay? It goes on what's previously happened in the past to tell you what's happening now. So it doesn't take into account any new news or any sudden movements. So that's what you have to think about when you're trading Bollinger Bands. But it doesn't mean you can't trade Bollinger Bands in the aftermath. Okay, so when they do widen, they will still widen around the market, and you have to use other techniques to understand when the market move back to. When a market overextends, as you know, Fibonacci comes into play. 80% of the time it retraces to 50%. That 50%, more often than not, won't be too far away from the moving average, which will be the middle of the Bollinger Bands. So if it moves down quickly or up quickly, the point the market generally comes back to will be around the moving average. Yeah? So all again, these things tie into play. There's nothing new in trading. There's nothing I can tell you that that isn't on every website, but it's how you use them together, okay, and how you use it in conjunction with your trading structure, style, and trading plan. That's what's important. Okay, so the moving average sometimes isn't displayed. You can set that in most charting things, but I like to have it displayed. Why wouldn't you? Why wouldn't you have the moving average displayed? I don't understand why it isn't. Okay, so always have the 3 bands. When the market is quiet, okay, the bands will converge, come together. When the price breaks out, they'll diverge. So it doesn't matter if they're close or further away, they're still giving you information. So here's an example of just looking at some Bollinger Bands. Okay, so we don't have a moving average on this particular example, but that's fine. We don't need it. Okay, let me just put the pointer on. So we can see we've got a basic, simple trend channel. So we all know what a trend channel is. Ultimate resistance up here, ultimate support down here. The dotted line is a midpoint. Okay, so that's really the parameters we're working within. As I said, as we always know with technical analysis, you don't get a finite line that it never crosses. But if you look, this is pretty good resistance. When the market trades underneath the red line, it gains momentum down. Okay, it's only here that it breaks out significantly at the end. But the Bollinger Bands encapsulate what's happening within the market and give you boundaries. Okay, so what happens is when you trade outside the Bollinger Bands for too long, the market doesn't like that and it rejects it, and you have almost an opposite signal. When you've been out the Bollinger Bands too long to get back in. So first of all, you're trading below this red line. So what's the first point it's going to hit? The midpoint. Guarantee, that's going to be near enough where the moving average is at some point. When you see this midpoint here, when we close below it, the market tries 3 times aggressively to close outside the Bollinger Bands. But look, when you see wicks, you see an indecision. So the market gets closer and closer to the low end of the Bollinger Band, and finally pops back inside. Okay, so your target to get out would be really the moving average before you get to the upper band. So this is obviously a longer time frame. So it depends what time frame you're using your Bollinger Bands on. I'd really use them on your hourlies and upwards, to be honest. I wouldn't use them on too small a time frames. Certainly don't go below 15 minutes because you get too much information. But what you're looking for is the market to reject the downward trend, because we know the trend here is downwards. We can see the market's in a trend channel. So we're looking for the market reject. So instead of selling into it, what we're using is the Bollinger Bands to buy back into value. So as soon as we come back into the Bollinger Bands, having rejected the close, the market goes up. So it does actually gradually come back down, but again, it follows the Bollinger Band to be support. Okay, so it's only when we're trading outside the Bollinger Bands we really want to pay any attention. Okay, when they're trading inside the range, it's not really of any interest to us, to be honest. I mean, if we drew a moving average in, the moving average would be probably something like, do that very roughly. Okay, so a moving average would be something like that. So what we could do is once we rejected the low end of the Bollinger Band, we buy above the moving average. That works quite nicely. But the biggest point we want to look for is certainly when we break out of the Bollinger Bands. Okay, so here and here. So we break out of the Bollinger Bands, that means we've got a reversal in trend coming. Okay, so the market's moving down, break outside the Bollinger Band once, twice, 3 times, 4th candle close inside, and market goes up. Okay, once, twice, hit the low end. This really nice level of support. Market then reverses. Green candle closes above the moving average. Green upper Bollinger Band hit. So, you don't always have to look for the big wins. It could be a nice small trade that gets you in. Here to here, or here to here and then here to here. That's still 3 good trades with very, very low risk. And that's what we're looking for, to eliminate the risk. The Bollinger Band tells you when we're trading outside of them. On the upper or the lower, it works both ways, that we're going to see a reversal. So you can tie that in with the RSI, see if the market's overbought or certainly oversold at these points, and then buy back when you get inside the Bollinger Band, head for the moving average, and then your next point's the upper band. So as I said, works the same way. Twice the market trades outside of the upper Bollinger Band. When it finally rejects, it comes back down, hits the moving average. Where's it going to hit after that? The midpoint, yep, and the moving average line. So it's 3 opportunities in this chart to trade based upon just trading outside the Bollinger Band. Okay, so you could do nothing else in that chart apart from buy here, sell here, based on really a 2 or 3 candlestick formation when we're outside of the upper or lower band of the Bollinger Band. We've got a nice target of the midpoint and the moving average, or the opposite parallel boundary. I mean, that's pretty nice. I mean, you know, if we get rid of all that information and just say, okay, well, don't know where I'd buy, where I'd really buy. If you just look basically the simple bits around, you know, the Bollinger Bands when you're trading outside of them, that's the extremes of the market. That's where you want to be taking the opposite view and looking for the market to come back to some sort of value. So that's just one example. I mean, that's a nice way of trading, isn't it? So the market, even though we've got the overall direction down, we can still comfortably buy when we see support, yeah, knowing that we're trading with the Bollinger Bands. The overall trend, as we've seen, is down, but it doesn't make any difference. You know, you're looking for high percentage trades. You know, you get into your trade here, when you come into the Bollinger Band, you don't go offside. Here, when you go into the Bollinger Band, you don't come offside. When it comes back into the Bollinger Band here, you don't go offside. So 3 trades where you don't really go offside, and you're at the absolute extremes of the market. Okay? Yeah, I mean, sorry, Buck, the midline's been taken out of this just because, again, I didn't want to overly confuse people, but, you know, the midpoint would just be a moving average in between. You know, I've got time at the end, I'll show you some of my charts, and, you know, it's simple. I'll show you the FTSE that I traded today. I gave 3 signals on the FTSE on my Twitter feed, and I made 500 quid. Okay? Didn't really go offside. All based around Bollinger Bands and Fibonacci. And when you see it work in action, guys, you know, it's glaringly obvious. So again, I mean, using 2 indicators. So in this particular example, also includes a trend channel. So anything else you can use to enhance your charts and look at the overall view is going to help you. Just having Bollinger Bands on their own is just one tool. Having Bollinger Bands working within a trading channel is a second thing. So what you want to do is always enhance your charts, enhance things. Okay, and that's really what you're looking for. Use your trend channels, use your Bollinger Bands, use your individual candlesticks, your cluster candlestick formations. Okay? Everything we've really done in in all my trading sessions and trading clinic is just bring things to the table. How many times have I mentioned Fibonacci? Okay, how many times have I mentioned Bollinger Bands? How many times have I mentioned, you know, higher time frame points of interest? Just them 3 things put on your charts will make you a better trader if you look at them in the right way. So they'll just putting this Bollinger Band in, we can see from this zoomed in view. Okay, the Bollinger Bands are rejecting the upper point of the Bollinger Band once, twice. We close inside the Bollinger Band and we see that individual candlestick. We know that's a doji. Yeah, okay, a little tiny body and big wick. That shows indecision. We then come back into the overall trend channel. Inside the Bollinger Band, a reversal candlestick. Inside the overall trend, 3 indicators in one window. Easy, we sell. Sell as much as we can, as fast as we can, the market goes down. That's how you trade. Okay, that's the signals you want to look out for. That's your strategy. So obviously we can add a moving average into the middle. And again, I didn't add a moving average because really, if you use anything modern, any kind of charts these days, it'll plot a standard deviation of 2 points around the moving average that you choose. So that's generally set at 20. But a lot of people, for obvious reasons, like to use a 50-day and 200-day moving average. So use a 50-day moving average because really that's a quarter, and a 200-day moving average is generally 200 trading days in a year. 20 trading days because there's 20 trading days in a month. But again, it's down to you. Obviously, the longer you go back, the smoother the curve will be. So a 50-day, 200-day moving day average will be smoother because you're taking more samples of data. So obviously, a 200-day period moving average will be a lot more desensitized to short-term moves than a 50-day, okay, as well as a 20-day. So it just depends on what kind of trader you are and what kind of length you want to hold trades for. My experience, as I said, the 20-day moving average on the hourly charts is absolutely fine. You can be a short and medium-term trader by using that. I wouldn't really try and, unless you're going to be a very, very long-term trader, wouldn't worry too much about the 200-day moving average, because if you're looking at a 200-day moving average, the likelihood is you're going to have to hold your trade for, 20, 30 days, a few months even. Okay, so it just depends on what trade you are, but these are the things you have to do. Decide what works for you. I can't just keep telling you what I do and expect it to work for everybody. It won't. So use the time periods that are valuable and mean something to you. So this is the same chart we saw before. So nothing has changed apart from we see the simple trend, the Bollinger Bands, but now with the moving average. So I crudely drew in a moving average, but it didn't look too different from that, did it? So the moving average, it gives you extra confirmation. So you see all along here, okay, let's keep with the basic principles. This is another way you can trade it. Overall trend is down, okay? It's sloping down. That's easy for us to see. So we come inside the Bollinger Bands, but look how the moving average now acts and tells us that it's acting as resistance. So the market then again closes, hits the lower Bollinger Band and moves out. So if you wanted to, you could use this as a signal that the market is increasing its downward move. So what do you do? Well, you look for the midpoint, don't you? You've got your trend channel in place, so you might as well use it. Your midpoint's here, drawn a line. So when they start to break out the Bollinger Band and move down aggressively, you can also sell into it and sell to the midpoint once we get out of the Bollinger Bands and can't make a significant low. And when I say significant, we can't get to the parallel boundary, then obviously this point here is going to be a reversal, and it does. Okay, again, the moving average, okay, market rejects. We see, a reversal pattern here on the time frame, hammer. Market then moves down, okay, all the way down. Sorry, that's terrible. Dear, oh dear. Okay, doesn't matter. Market here has a reversal pattern in the charts, doesn't get above the moving average. So where does it hit? The moving average, sorry, the lower end of the Bollinger Band. Moves down, and again, we see the same scenario. Market moves back up. Where does it finally test the moving average? So, you can get out your trade from here to here. But if you want to hold it longer, from here to here. The opposite boundary is always, ideally, where you'd like the trade to go. So again, the moving average here, once the market is acting as resistance, once we finally break through, the market here starts acting as support. We break through, but can't close below it, indicating the market's moving higher. So your Bollinger Band, the upper end, is all your exit points. So we finally reverse, come back down, hit the moving average. So again, it's down to you how you trade it. But if you look at the Bollinger Bands, the midpoint will tell you what the market's thinking. We're moving a downward trend, come inside the channel, moving average acting as a resistance, market moves down. But then eventually, the market then rejects the lows down here, moving average acts as a line of interest, acts as support, market then moves up. Okay, so you can use it again, however which way you want, whatever. It's down to interpretation. I can show you Bollinger Bands, I can show you Bollinger Bands with moving averages, I can show you how I trade it, and I trade it on the extremes. So I'd be going against the trend, I'd be buying back into a downtrend. Okay, so I might only ever do 2 trades on this entire chart, but I'd hold them. I'd hold them to the moving average, hold them to the moving average here. Okay, so I'd make good money out of them 2 trades. Easy to say in hindsight, but you go back now after this webinar and check your charts and see, if you don't use Bollinger Bands, go back and whatever charts you look at, put Bollinger Bands on and see if there's a little candle moment, a little light bulb moment where it goes, yes, well actually, I get it now. Then Bollinger Bands are working quite nicely. And you can use them for continuation, you can use them for reversal, you can use them on any time frame you want, as long as it's not too low, and then see if it ties in. And if it does, it's another easy indicator to give you confirmation that your trade's right, or maybe to say, well, hold on, we're not trading outside the Bollinger Band. Maybe this market could just go a little bit further down. So it helps define and refine your entry point. So far, I don't see any downsides having the Bollinger Bands. So again, I'm using this as FX markets, because this is the euro dollar, all these charts. But it could be anything, it doesn't matter. Bollinger Bands work based upon, a moving average. So it can be moving average of any piece of data. It could be pork bellies, S&P, FTSE, any kind of exotic currency pairs you like. So it doesn't really matter at all. That's the whole point. Anything I teach you to do with Fibonacci, Bollinger Band, or higher time frame, support and resistance, it works in any chart. Yeah, that's why my kind of take on the markets is quite unique, because I'm not looking for any piece of data to justify back testing. It works on pretty much everything. Yep, there'll be times it doesn't and you get blown out of the water, but that's when your risk strategy comes into play. But this is edge trading. You will get a much greater than 70% edge using Bollinger Bands and coming back into the range than you will in any other method that I know. Who wouldn't take a 70% edge every time you start trading in a day? I would. And that's what that's what I'm trying to bring to the table here. Things that consistently work. So again, looking at the chart, we can see the close of this bar as a reason to enter the short. Again, the candle's closed with a Bollinger Band inside it. Okay, it's rejected a close outside of it in that up move. The candle itself is indecision in the market, bit of a doji candle. We're moving back in towards a trend channel, towards a moving average. So 3 things you can use for your entry point just based upon that one candle. Now, that's enough for me. That's enough to get into a trade. And if you're aggressive, when we close inside, the trend channel line, the line of resistance, you double your trade. Double your trade, get half out of the moving average. If we don't get as low as the bottom end, then fine, we get some of our trade out. But that's how you trade. Get short again, profit. If you don't get to here, take some profit here. That's how you make money in trading. Positively averaging when you're going with that kind of trend trading. So why Bollinger Bands work? Well, the main assumption is the market trades and trends about 80% of the time. Okay, and it does between the upper and lower bands. So you get an 80% edge if you use it in that way. Okay, that 20% of the time, the markets are trading outside the Bollinger Bands and the market's going wild. Therefore, 80% of the time, they're going to come back into the range. So I haven't got any real kind of statistics apart from my 10 years in the market. So hopefully that's enough. That 80% of the time these things happen, and that's good enough for me. And if you tie in that with that overextended market theory, that 80% of the time an overextended move retraces to its 50% level, then if you use Bollinger Bands and Fibonacci together, that's a powerful, powerful combination. So remember, in theory, it takes major news or a new event to make the market to reprice itself. So when Mark Carney, spoke in the minutes, we saw the cable shoot up, and then it shot back down to 50% and then carried on down. So you could have traded that with the Bollinger Bands and the Fib. That's new news. Okay, so basically, buy when the price hits the lower band, sell when it reaches the upper band. Or for me, I like for them to close or try and test outside of it first. Buying on the bands is like buying on the moving average. Okay, it's like buying on your level of support and resistance. These levels here are to be tested. So I'd always recommend letting the Bollinger Bands be tested first and see if they break through. If they break through in a little wick and then close back inside the Bollinger Band, then that's your confirmation. Biggest mistake traders make is trading off things like the hourly charts and not letting the candle close. You have to let the candles close before it's a decision. A candle can move in the last 10 seconds of its trading time and period and completely change the horizon in 10 seconds. So a 15-minute candle, if you're trading off that, you have to let 15-minute candles close before you get in or get out of a trade. That's the only way you get better at trading, is by sticking to the candles closing. If you're a 4-hour chart trader, like Clifford maybe is, you have to let that 4-hour candle before you get out or in a trade. Okay, if you don't, you just never get in the full extent of any move. Hard to do, guys, especially when the market gives you that profit and then takes away, gives you some profit, takes it away, and then finally goes, but you have to let the candles close. What do I mean a 15-minute candle? I mean a 15-minute candle. I mean, whatever candle you're looking at is on a specific time frame. So you have daily candles, hourly candles, 30-minute candles, 15-minute candles. If you're trading off the 15-minute charts, 15-minute candles, you have to let the 15-minute candle close before you get in or get out of a position. That is if you want to hold it. If you just want to be a scalper and be in and out, in and out, in and out every 2 minutes, that's fine. But you're going to be trading on a spread betting platform like me. So every time you do that, you pay the spread and you go offside. So for me, you need to look for them bigger moves, them more juicy moves, and average in. Make more of your trade. So again, remember, think of the markets as a coiled spring. So the longer the price action moves sideways, divergence between 2 points of, support or resistance, the more likely it is to break out. So we know that. We know that with trend channels. We know that with support and resistance. So Bollinger Bands are exactly the same. So if the Bollinger Bands are really, really close together, that's a great signal to look for. Because if the markets are like a coiled spring and something new comes out or a trend breaks, the closer Bollinger Bands are together, the more likely they are to break. Okay, so that's a great thing to look for in the markets. Tie that in with the RSI, tie that in with the market sentiment. But if these Bollinger Bands are really close together, eventually they're going to break to the low side or to the upside. And that's what I like about them. Again, if they're very, very far apart, then at some point they need to come back together. So they work on both ways, but it just depends how that fits in with your style of trading, of course. So again, an observation that I've made over the years is one of the biggest failings that many traders have is trading against the trend. Okay, trying to pick tops and bottoms, the highs and lows of markets. Okay, so Bollinger Bands, you can argue that is a way of picking tops and bottoms, so you might get caught out. But again, what I'm saying is, these are telling you that the market is trending in one direction when the Bollinger Bands are far apart. So you wait for these Bollinger Bands to become a point of interest. So as long as we keep breaking outside the Bollinger Bands, the bands on the upper or the lower side, you keep going with the trend. When they stop and close back inside the Bollinger Band, that's a reversal signal. So you don't just keep, picking the tops and bottoms if they don't correlate or coincide with the Bollinger Band. You don't say, well, we're hitting the upper Bollinger Band now, the market's moved 10 ticks in a straight line, I'll sell that top because that's the top of the Bollinger Band. Why would you do that? Yeah, that's not the right kind of indication. If you say the market has gone up 50 ticks in a straight line, the RSI is printing at 78. We've just closed one candle outside on the hourlies on the upper end of the Bollinger Band, and the next candle's closed inside the Bollinger Band, and the RSI is still 78. That is a good indication the trend might be reversing because we're closing back inside it. While we're outside the Bollinger Bands, anything's still fair play. So that's the whole point, letting the candles close. Yeah, back inside the Bollinger Bands when we've hit the extremes indicates a reversal. But, again, help yourself out. Tie it in with the RSI, tie it in with the MACD, tie it in with anything else you want. Anything else that you use in your normal trading activities. So again, look at this example. Rule 1. So use an hourly chart to determine whether the market is bullish or bearish. Okay? Then understand how this fits with your view on the market. Where is your support and resistance levels? Where are your trend lines? Yeah? Full green body, full red candles. They show you the volume that prices are trading at the time, at every price. When the big green candles, everyone's buying. When the big red candles, everyone's selling. When you see the little bodies and the big wicks, that's just price spiking. Okay, that means a price has been hit and prices have been missed in between that. People aren't finding value at each price. Okay, so they're good things to look out for. RSI, any other oscillator, will tie in your overall support and resistance and overall trend. It will have to tell you. So if you look at the trading activity above, the moving average, then the market is in bullish mode. Therefore, look for buying opportunities. If it's below the moving average, look to sell. Okay, so the moving average, again, when we're trading above it, the market's, again, going back to the top end of the trend. Yeah, close outside the Bollinger Bands, market moves down. So it depends if you want the little moves or the big moves. So, like I said, if you want to be a scalper, you can just scalp these, upper opportunities for a few ticks. If you want to be a position trader, then you start to average. The more this goes outside the Bollinger Band, you sell more and sell more and sell more, knowing eventually it has to get back to the moving average. So again, it depends on the time frame of chart you're looking at. It depends on the time you want to stay in the trade. But when we're trading outside of the Bollinger Bands, that's when you want to prick your ears up and have a look at the market. Doesn't mean just because we trade outside the Bollinger Band, you've got a license to sell or buy. It just means you've got an indication the market is doing something. It's overextended. So tie it in with your RSI, another support and resistance level. When you close back inside the Bollinger Bands, that's when you might get the reversal. So again, rule 2, if the candle closes above the moving average target, okay, there's an opportunity when the next hourly candle opens to get a 50% retracement of the previous hourly candle. And that can be your entry point to either get back in or, to carry on with the trend. So you have to understand if you're going with the trend or against it. So this market has moved, big solid green candle. Yeah. So when the market is finished doing that and the next candle opens, this next candle retraces back to 50%, yeah, which 80% of the time it does, and then it continues to move a bit higher. So, you know, you can use that as an entry point to buy back into the market, yeah, and see if it's going to test the upper end of the Bollinger Band again. Or again, I'll wait for that 50% to break. When it finally does, yeah, then the market hits the moving average and goes down. So again, remember, two candles that move like that very strongly in a direction still have relevance in the market. So the 50% level of this green candle here will act as ultimate support or resistance. Okay? And that's just another thing to look at. The candle here will act as ultimate support or resistance. Okay? And that's just another thing to look out for. So you tie it in with the moving average and the Bollinger Band. Yeah, and you either keep buying above that because you know you're finding value on that 50%, and when it breaks it, finally, that all these bulls are out of the market and the trend's reversing. So you can have 1, 2, 3, 4, 8 times to buy on that 50% level here, and when it finally breaks it, one good sell signal. So remember, the 50% of a Fibonacci on a big extended move, tying in with Bollinger Bands, is very powerful. Okay. So rule 3, if the bar closes outside the upper Bollinger Band, you're now waiting for a confirmation of a breakout. So that confirmation is the next candle makes a higher high, and it continues to move in a bullish direction. Then you've got bullish confirmation, so you can either keep buying when you're outside of the Bollinger Bands for your next level of resistance, or you wait for it to have a reversal signal and then come back into the Bollinger Band and then sell into it. But then you can't go short until you've had confirmation the overall trend is changing. And that won't happen until you see an individual candle, like a doji, or you see us close back inside the upper Bollinger Band. So again, we're trading outside the Bollinger Band, you've got free range to buy as much as you want, okay? Because the market's overextended. The second it stops doing that, it's going to look to come back to fair value, the moving average. When it closes inside the upper Bollinger Band, that's when you want to sell. Okay, so all seems pretty straightforward so far. So again, I mean, if you want to trade a bearish pattern, so if the market's going down, then what you want to do is in the following chart, we're going to see 2 confirmed breakouts and the one that failed to materialize. So how we're going to trade this is step 1. Go short of the close below the moving average. Okay, decrease your trade size by 50% or completely when we hit the lower band, or decrease your trade size by 50% and close completely on the second close below the first breakout. Okay, final profits are taken when we're back inside the moving average. So we'll show you that in the example. So this were charts, again, they seem to be a little bit more complicated, but they're not. But this is what I say about MACD. Okay, so MACD or RSI, when you put it in your charts normally, will take up room on your charts, but use it in conjunction. So what we're looking for is a confirmed breakout. So when the market closes below the moving average in the lower band. Yeah. So let me just try to have I written this. Seems a little bit overcomplicated, that, to be honest. To go short the close, below the moving average, decrease. Right. Okay. So what we're saying is here that if you want to use the Bollinger Bands in accordance with the trend, then what we're doing is we can see the overall trend channel that we've shown before. The market is tracing the moving average here. So when we close below the moving average, once, twice, 3 times, we look to get short and the lower Bollinger Band to be the exit point. Okay, so the market's here, it comes back down to here, and then we look to get out the trade. So when the market starts to come back inside the Bollinger Band and close inside it, that's when we exit the trade. So that's only really a very, very, very small trade. Okay, but we're still going with the MACD, still telling us the market's moving downward direction. So again, when the market again rejects the upper close above the moving average, we get short again. Again, the lower end of the Bollinger Band is the target. We close outside the Bollinger Band this time. So the next candle opens up, go short again. Until we close back inside the Bollinger Band, don't get out. That's a much better trade. Again, the MACD is a lot more exaggerated, showing us there's more momentum down in the market. So first trade, not so great. Second trade, not so bad. I mean, you might have got squeezed out of this trade here by the market rejecting and coming back to the moving average. Or you might have been brave and gone right until we close above the moving average, going to keep short, sell some more here, then the selling action comes in. 2 great big red candles, a great trade. Okay, so same here, the market closes outside the Bollinger Band, but we can see the MACD has gone positive. So we're not really sure the market can extend any further. We're at the low end of the of the Bollinger Band and also the trading channel. So we're looking for buys. So when we close inside it, the MACD starts to go up, correlates with the moving average, gets even stronger when it hits the upper band. So that's another good trade. Yeah. So again, MACD starts to go waver down, starts to come negative. Okay, we reject the upper Bollinger Bands, close inside the moving average. The Bollinger Band is broken. When, again, remember the momentum comes into the market generally 2 or 3 candles after you want it to. So we can all say we're going to get short here, but might get squeezed out here. But we've waited too long, so we say, I've waited too long for that profit now, and then the market does exactly what you think. Yeah? Here, squeeze, squeeze, squeeze. Oh, it's rejected. It's taken all my profit back. Green, green, green. So all you have to do is, again, let the candles close and wait. You have to let the charts do what the charts are going to do. So many a times people get squeezed out of these positions, okay? Because everybody knows people are going short. So you get squeezed out here when you're short. You get squeezed out here when you're long. Okay? That's, again, people know exactly what's going to happen. That's why you have to trade these things with conviction. Otherwise, you're not going to get the juicy move here. Yeah, you're not going to get the juicy move back here because you're not giving enough candles time to happen. If your entry point's here, you never go offside. If your entry point's here, you never go offside. Just because the market is moving like this doesn't make any difference. It's still moving down. Just because the market's moving like this, it's still moving up. So it doesn't really matter. As long as you don't go offside or really significantly against your trend direction, then you're still doing all right. So again, guys, these things take time. And at RSI and MACD, these kind of things will give you a double confirmation. But the principles still remain. Okay, either go with the trend and sell below the upper band and the moving average of the lower as your target, or when the trend reverses and you see the MACD, RSI changing, or you've hit a solid line of support, when we close inside the Bollinger Band, your target's the moving average and then the upper band, so the opposite. So again, putting theory into practice, the previous slide explores a simplistic approach to using Bollinger Bands. And again, you can use it in the 2 ways I said, with the trend, using them as resistance, or against them, using them as support. But the fact of the matter is, if you're involved and the Bollinger Bands are far enough apart, you're dealing with the extremes of the market. Okay, so your RSI should back that up. Okay, if there's no new fundamental news out, then maybe it's just a technical break. But the whole point is using things in correlation to make them a stronger individual signal. So Bollinger Bands and trading psychology. So as I keep saying, these things work because they encompass the market sentiment. Okay, so if the majority of people are looking at Bollinger Bands, they become self-fulfilling. Everybody looks at RSI pretty much. Everyone looks at a moving average. So you need to. Okay, so that's what you have to do, isn't it? Look at the things that everyone else are basing their decisions on, and then wait that little bit longer. Yeah, absolutely, Buck. That's the absolute battle. And I can say these things, because it's easy because I'm showing from past examples. But I know how hard it is to stay in trades. You have to force yourself. If he's not telling me to get out, he's not told me I'm wrong, stay in longer. You know the average daily range. You know the average trading range. You know the high of the previous day. You know the high of the previous week. So you know how far the market can extend. So you have to keep that confidence and keep saying, I'm not wrong, I'm not wrong, I'm not wrong. I'm in profit, I'm back to flat. I'm in profit, back to flat. But I'm not wrong. I haven't gone in the opposite direction yet. And then when the market goes, you wait the extra 2 candles and you make all the profit. That's what you have to do. I don't have any target in pips, and that's it. So when you say stay with trade conviction, how do you not get stopped out of these squeeze points? Well, the squeeze points, really, you're on side. So it was just you're on side and the market was squeezing back and taking your profit. It didn't actually squeeze you in the wrong direction. Okay? But, if you're involved in the outside of the Bollinger Bands, the upper and lower period, then the market can only go so far. And that's when you have to do things like negatively average and understand that you're viewing the markets right. Look at other conflicting and correlating markets. I was trading the FTSE today. The FTSE was negative. All of the markets were positive. Trading outside the Bollinger Band, hit a key level, and you buy. Within 15 minutes, the market had blipped up 20 ticks to co-align with the DAX, the stocks, and the S&P. Okay? Yeah, and I don't get stopped out because I trade small enough size to average in. So it's not like a casino that you keep doubling until you win. But I've been trading for a long time, guys. You know, so if I trade outside the Bollinger Bands, I know I've got enough firepower to buy or sell enough to make sure I can make a good average for it to get back inside, because they can't stay out of, you know, of fair value for forever. They just can't. You know, the odd time you do get blown up, but this is percentage trades. 80% of the time, you're going to be winning on these kind of trades and these kind of trading strategies. And so the eight times out of 10 you win, the 2 times you lose, you got to make sure you just don't get wiped out. Simple as that. Don't get greedy. You know, if it's not working, then stop doing it. Stop yourself out. So again, using Bollinger Bands is just one tool. I'm not going to say it's the answer to all your prayers. It's certainly not. But if you use it in conjunction with MACD, volume, RSI, it's going to give you a good idea of what the market's thinking. And if you know the market you're trading doesn't work well with Bollinger Bands, or it isn't exhibiting the things you want to see, trade something else. You can draw support and resistance lines in anything. You can use RSI, MACD, volume, and Bollinger Bands on any single tradable product. So don't just be confined to being a footsie swing trader. Just be a value finder in any market. So flick through the daily charts or flick through the hourly charts and just put a Bollinger Band on and see where we're trading in relative terms to the moving average. If we're way above it or way below it, could that be a nice opportunity to get back towards the range? Try it. Try it on the charts you use. If it doesn't work, don't use it. So the basic summary is Bollinger Bands are just another tool in your armory. Okay, they've been used for both the passive in non-trending markets or the aggressive for breakout trades. They should be used to indicate whether you should go short or long if you're trading outside of them. Or again, you can use them as parallel points to exit if you're trading around the moving average. They should always be used with another oscillator to get extra confirmation. I told you, MACD, RSI, probably the best ones I would say to use it. And it's a percentage gain. So keep learning for when they work for you. Keep using that technique. When they don't, stop it. You know, it won't just guarantee to make you money, Bollinger Bands, but I guarantee if you overlay it on enough charts that you trade, enough time frames that you trade, you will start to see a correlation. Okay, so again, use the midpoint in the Bollinger Bands. That's pretty much standard with MetaTrader, but use the midpoint as a good target point, or a good set-off point, a good entry point. The moving average will always play a part if the Bollinger Bands are playing a part. So you've got 3, an upper level, a lower level, and a mid-level. So for 20 periods, 2 standard deviation, the Bollinger Band gives you a lot of bang for its buck. Okay, tie it up with some other oscillators, tie it up with the other techniques. It can't harm you. Okay, trust me. Any questions, guys? Okay, look out for all my other stuff, guys. Trading clinics every week on FX Street. I'm going to be doing a monthly one on higher time frame trading on FX Street, a 2-hour presentation on Monday. So join me on that, Monday the 12th. That's going to be a big one, highly promoted. We're going to have big numbers. So again, free range to ask me questions on any product or anything you want. Anything else you need to know, Steve Roughly, at Steve Roughly on Twitter. The best way to get hold of me, guys. Ask me stuff on Twitter and just sign up and follow my trades. Or don't follow them. Go against me. But, you know, again, guys, when you look at my charts or my trading clinics, I always have Bollinger Bands up. I always use Fibonacci. You know, there's no mystery. These things keep working time and time again. And trust me, I would never tell you things, guys, that don't work. I don't just turn up on these seminars for no reason. I come in, week out. I trade every week, every month for you to make sure you understand all the teachings. I'm not just one of these professors who say things because I wrote a book. You know, I haven't got time to write a book, so I do it in the best way I can, webinars, and then I trade and make live money to prove they work. All right, guys, anything else you want to know, you know, you can find me. I'm not a difficult man to find. Always a pleasure. Great to see the familiar faces. A good turnout. So thanks, guys, and I'll see you all very soon. Have a great night.